So recent success story for Brittany and I and our family. Ed with Northpointe Bank just helped us get what was an all-in-one line of credit. So I had previously in my life thought it would be amazing to do something like that on my house, but the concept was so foreign to me, and then it became a reality because Ed reached out to me about like, hey Ryan, I've got this business proposal, and I was like, I don't want to really take another meeting with another lender, but yeah, let's do this. Let's sit down and talk about it. So you sold me on it day one, and then I was like, well, Britt, we're giving up our like 2.65% interest rate to go get a near 7% mortgage. So that's completely stupid in many ways, but you made it a reality, and it also increased what I was looking at because you were able to look at all my business income. So we went from a brand new construction house to a different brand new construction house, all based on one product as a business owner. So obviously you have a lot more to share about that, but there was no one better to explain an all-in-one line of credit than the expert himself. So I was like, Ed, we gotta tell the masses about this. So what is an all-in-one line of credit? Why would someone do a mortgage like this versus more typical financing?
Yeah, so the all-in-one loan is definitely for a particular type of borrower. You generally have to be cash flow positive, or maybe you're a saver versus a spender. You need to be one of those people that you budget. Having money left over at the end of the month is one of the most crucial pieces to the all-in-one loan. Because basically you are combining your checking account, your savings account, your mortgage. That's kind of why they call it the all-in-one loan, is all income goes in, all expenses go out, and whatever we have left over at the end of the month is just reducing our mortgage balance. Mm-hmm. So most people would not be willing to put every dollar they have left over at the end of the month towards a traditional mortgage, because when you do that, if you were to do that, that money, poof, it's gone.
Yeah.
With the all-in-one loan, we have a checking account that's attached to this line of credit. So any amount of money that you put towards it, if you needed it in 6 months, 12 months, or even later, you still have access to it. So in terms of the business owners, though, piece to it, that is really a huge concept, because so how we do normal approvals for with Fannie Mae or Freddie Mac, we are looking at net income, right, after deductions. That's generally how business owners are going to get approved. With the all-in-one loan, we can use a percentage of your gross deposits on the last 12 months of bank statements to be approved. And that's where oftentimes we can say yes, where others may say no, or others may be approved for less, and now we can be approved for what you can truly afford as a business owner. Mm-hmm. There's also a payment flexibility piece to that, right? Business owners can make, $50,000 a month or negative $10,000 in a month, right? And as a result of that, how the payment works is interest just gets added on to the loan amount. So if you have availability in that line, it's okay that that we have inflows or outflows in certain months, and we can still
Well, that actually was like an important question for me when I was considering the loan. Is like, well, you're aware of some of the projects that I do. I do larger renovation projects. We do a lot of commercial. I said, if I'm going to put $100,000 of pending commissions coming in on this line of credit, what does that actually do to my payments? So how do I actually access that? So one, what does that do to the payment on a monthly schedule? Because if this is a line of credit, I have a checking account, what does my access to that look like? Because it's not like a financial account where like, hey, it's a couple days. You told me it was instant. Mm-hmm. Well, what does instant look like? And what does that payment look like?
Yeah. So the beauty of that is, so if we were to make an extra deposit, right, or if we had a commission, a larger commission than normal, or we had a bonus if you're a W-2 employee, when we put that lump sum towards the line of credit, what that means is just less interest is being added on that following month, which means if you're still getting paid the same, mm-hmm. that just means more is going to the principal, which means that it's compoundingly paying off faster. So the more money that we put towards it, the less amount of interest we pay. But because it's my checking account and because all of my income is actually reducing that line amount, it just means that the balance of my mortgage is going down substantially faster.
Which, for me, this is part of the success story, guys, why I considered giving up a 2.75% interest rate for what then, because this is based on what was the rate?
So we have a simulation that we run online. We say, okay, do you get paid every week, every 2 weeks? Do you have quarterly bonuses, right? We plug in the net income that would go into the checking account. We then run expenses, right? Gas, grocery, entertainment, paying off our credit card each month, so on and so forth. We run that and we say, okay, based on this amount going in per month, this amount going out, I would say that if this product works for the individual, and again, this is really catered towards like maybe 20% of the population, where 80% of the population unfortunately just lives paycheck to paycheck. But for the 20% of the population, I would say that our effective APR is going to generally be between 1 and 2% when we're quoting for people, which is pretty incredible.
We went from thinking that we were going to hold this 2.75% rate for the next 25 years because we had already paid 5 years towards it. Be like, why would we ever give that up? To actually, why don't we just pay off our house as fast as possible? Because now I have a line of credit access. You're going to have to remind me of this because I don't remember. How long can I access this line of credit?
So for 10 years, you have the full access to the whole line. After year 10, over the next 20, they just start to slowly reduce the amount that you can borrow from it. So $1 million line, let's say, they take $1 million divided by 240 over the next 20 payments, or 20 years of payments.
Sure.
And per month, that's the amount that would be reduced. So in that theory, what that means is even in year 20, we would still have a $500,000 line if we started with $1 million.
Which is fantastic because now we're going to be, in our minds, and I'm only sharing this because it's success for us, and other business owners might be thinking of it for their business, like, well, I can lend against my personal assets, and I can take that money to invest into my business, right? So, and there's a cheerleader in the background right now, and I love it.
I'm wondering if we can hear it.
So, doing that to invest in myself, it makes sense. Okay, so now I'm going to become personally debt-free and be able to take out these assets for the next big purchase because I've already built that stability. So I think it's extremely paramount for business owners to consider that because there's other tax benefits there too.
Absolutely. We do work with a lot of investors, right? Particularly for that reason. If somebody is flipping properties, right? Well, why borrow at, say, 12% and pay 2 points to borrow that money for a certain amount of time, where instead now we can say, okay, well, maybe I'm borrowing at 7% or even less right now, like it's at 6% in some cases, and the interest that's on my mortgage may reduce my taxable income.
Yeah.
So
I think as we wrap this up, because it doesn't need to be a long video. So for us, debt to income ratios, bank statement ratios, how is this product different than even those other? Is this a non-QM product? What is this?
Yes. So there's only 4 lenders in the entire nation right now that offer it, Northpointe being one of them. It's only been around for like 20 years, compared to normal mortgages that have been around for 100 years. So there's different parameters at different places that you go to, but we have to have a little bit lower of a debt to income ratio. You have to have some reserves. You have to have at least a 700 credit score. You got to have 20% down, right? You have to be a really strong borrower. But if you are a strong borrower and if you're buying a $1 million, $2 million, $3 million, right, dollar home, we can have these lines go up to $2 million on a primary and second home, or even $1 million on an investment property. If you are that criteria, generally speaking, this loan can really benefit somebody. So.
Okay. Well, how should they get a hold of you if they want to get access to this type of lending?
I would say you should be able to find me on social media, Ed Naparelski with Northpointe Bank, or through Ryan. He can certainly get us connected.